I just gave a talk at Stanford's Business School, and the students had some really good questions. I wanted to share both their questions as well as my responses. The talk covered three particular things. One, what kinds of companies you should think about working for in fintech. Two, what types of roles to consider. And three, if you wanted to break into venture, what that looks like. So in this Q&A session, we go deeper into each of those three areas.
Why shouldn't I join like a pre-Series B company, early stage as an early employee?
I invest in pre-seed and seed companies. I obviously hope that really great people join those companies. One of the reasons I don't think you necessarily should is because once you start getting below that, there is a lot of risk inherent to the business. And so once you get kind of pre-Series B, you should start thinking about joining an early company or starting your own company. If you start something, I think that's great. I think more people should be doing that. I think it's a great way to learn a whole host of things about how to operate. Also, when you're in a really dense ecosystem like the Bay Area, I think one people don't understand about how this ecosystem works is I have so many friends who have started companies. Those companies have failed, and then they have joined a new organization as part of a soft landing and acqui-hire 2 or 3 rungs higher than they ever would have been hired. And that's why this one of the many reasons it's such a magical ecosystem is that failure can actually be a career accelerant. And you often hear people say like, oh, we embrace failure here. But I didn't really internalize that until watching this play out multiple times where you see people fail in some sense on a company and then actually see that as a career accelerant for them. Like there are whole companies that specialize in hiring XYZ founders to like be GMs of XYZ. So one is you should think about starting something. But then two, if you don't want to start something, like why would you join someone earlier? I do think if there's a founder you find who's building in a problem space you find super compelling and you're just super excited about it, you should still do it. Because the reality is at a pre-seed or even a Series A company, there are going to be some pretty material bumps in the road. And if you're not just committed to the mission of what that company is doing, you're probably not going to show up as a great employee. And so you can't just be a mercenary showing up being like, hey, I want to join here because that's going to give me the most potential upside. You have to be really committed to the mission. I think some of the companies I've backed are really interesting companies with good work. And so I think that's why people go and join them. But if you want to be like more mercenary about where is the risk reward trade-off, which again, being a mercenary is maybe not the best way to approach your career holistically, but I think the Series B is a great place. And again, Series B's right now, because of the correction in the market, there's actually better signal to noise ratio about the good companies out there to join.
Okay, so I should join a post-IPO company then.
Yeah, and then the other question is why not much later? This is where it also comes down to personal proclivity and your own background and experience. As you become more senior in your career and you're kind of more informed about the set of opportunities you feel uniquely tailored to, oftentimes it starts to make sense to join later and later stage companies in senior leadership positions. Usually, as someone coming out of Stanford, as even a master's program, you're not going to get a C-suite title or an SVP title at a Series C company. So you kind of have to pick how can you join a company that's growing where that role can grow into that in 2 or 3 years. Whereas if you joined a company, it would probably take you 5 to 7 years to try and get promoted to that level. But if you're like, no, if you feel like that's wrong and you're like, I know why that's wrong and this is why I want to join, then you're probably right because you know your own story and skills and all that better than I do.
Okay, so I do all that and then I want to break into venture afterwards. Do I just kind of call up one of the partners and ask for a job? How does that part work?
Yeah, it takes 3 to 5 years, and like I talked about, I think the biggest thing is doing a little bit of angel investing, but also building networks to sort. If you think about venture, the framework is you have to source deals, you have to pick deals, you have to win deals, then you also have to support the founders that you back. And sourcing is very, very important, and especially for more junior venture partners, that is probably 80% of the job, and maybe call it 70% of the work, and it's 90 to 100% of the reason you will get promoted to the next level is because you source and therefore invest in a really great company. The picking and the diligence will come down to you as well, but that's going to be overseen by the entire team who's going to decide whether or not to move forward. So sourcing is incredibly important, which is why you start with building networks to identify great companies. And you can do things, you can do content, right? You can, which is something I've done, you can build communities, but the easiest, simplest tactical thing is to basically build a network of investors at firms that you know, and usually start with folks who have just gotten started there.
So would you advise the people in this room maybe start cutting checks into their classmates' companies, organizing events?
I don't know, like angel investing is also a good way to light money on fire and not spend, just take time, make sure it's something you're really serious about if you do want to do it. If you get 3 to 5 years into it and you do want to get serious, another approach that's on the table I'm not saying this is the right approach for everyone, but it's very exciting that this exists as an opportunity, is you can raise a microfund. You could raise $1 million. You could raise it literally maybe even from some of your classmates, maybe from some of the professors here, maybe from the executives from the companies that you've worked at before. And you could try and deploy that into 20 to 25 companies over 2 years. And now all of a sudden you have like a real tangible track record to either show to prospective LPs to raise a larger fund in the future, or to go out to venture firms and be like, hey, you're looking at 10, 20 candidates for this role. I literally invested in these companies, built the firm, did the fundraising. Like, you're just a very strong, compelling candidate. 5 or 10 years ago, the infrastructure to get a micro fund up and running like that didn't really exist. Now you can do it on AngelList. And they actually even have some programs, so they recruit ex-operators. I have a friend, Jake, who runs a program called Spearhead, where they give ex-operators, usually technical ex-operators, $1 million to basically figure out what it's like to run a venture fund, with the idea of graduating a subset of those into running micro funds of $10 to $15 million. So there are some alternative pathways into doing and becoming a full-time venture investor that I think are pretty exciting and more people should be trying out.
What are you seeing in fintech at the moment, Rex? What's going on? What's getting you excited?
The main thing I'm excited about is, one, the quality of talent in the ecosystem. So if I came to Stanford 10 years ago and was like, who here has worked at a fintech? None of you would raise your hand. And now it's like, oh, a bunch of you have. And that's very exciting. But if you dial that across the whole ecosystem, probably, and I don't just invest in repeat founders. I happen to have invested in a lot of repeat founders because there are a lot of repeat founders in a way that wasn't true 10 years ago. So about 60 to 70% of the portfolio is full of repeat founders. And these are folks who have built companies 1, 2, or even 3 times before. So one is just the quality of talent is better. And it's not just at the founder level, it's also for the founding team. If you've worked at 2 or 3 companies, especially if you've helped found them, and you're like, I need to hire a person who has this kind of sales expertise, or this kind of engineering expertise, or this kind of product expertise, you probably know 10 people in each of those functions that you can reach out to, and you know which ones of them might be in the right place in their career to join. Whereas if you go back, if any of you have watched any of the interviews I do with founders of later stage companies, I often like to think about in this context, like John Stein at Betterment or Ken Lin at Credit Karma. 2009, they're both starting companies. And there are these big existential questions like, who do I hire? I don't know. Like, I've worked at a big bank or an asset manager, and none of these people are entrepreneurial. How do I build it? Well, if you're Betterment, you need like a stock trading API. Well, that doesn't really exist. It comes along to exist a little like a year-ish later or so, and it's Apex. Who do you raise from? No idea. At that point in time, Ribbit, I forget what year Ribbit is actually founded, but like they're just getting started. QED is still kind of a family office. A16Z doesn't have a fintech practice. So you have no idea who to hire, how to build things, who to raise from. If you fast forward today, you've got a lot better talent. All those questions are very answerable. And then if you look at the size of the market, the amount of revenue captured by fintechs versus incumbents, it's like 2%-ish. So it effectively means that the entire market is still there if you know where to look. If you don't know where to look, you're going to see a lot of derivative ideas and very competitive spaces. But if you know where to look, there's some really big, interesting opportunities. And people say, like, what categories am I excited about? I always struggle with it because I actually, if I had to categorize the 28 investments I've made, I'd probably put them in 11 different categories. So I've done things in wealth tech, I've done things in prop tech, insurtech, fintech in the intersection of healthcare, fintech in the intersection of human resources, vertical SaaS enablement, so embedding financial products into vertical software, financial infrastructure, bank tech, so selling tech into banks as the buyer. And all those companies are very, very different and very, very interesting in their own right, and not like anything I'd seen, call it 10 years ago. So it's the size of the opportunity, the quality of the talent, and the diversity of the kinds of opportunities are all very exciting.
I was interested in the distinction you made between tech, product, and solutions companies.
Yep.
I was just thinking there's a lot of like API-forward tech companies that also have very large solution engineering teams. How do you distinguish between that? Like, if we're trying to find a solution company to join, what distinguishes it from a tech or a product company?
Yeah, usually the way you know it's a solutions company is you have a large solutions org. And that's both good and bad because solutions orgs can slow down. Like, if you don't have a solutions org and you're just like selling a technical project that's like a widget and you can do a bottom-up SaaS motions, that's good because you can get good technical growth. But if you want to sell really big, large enterprise contracts, then you're almost always going to have a solution org. When I think about solutions engineering, some of my orgs or companies that I've backed, well, one of them actually I talk about, my wife is an executive at Guild. Guild sells education as a benefit into Fortune 100 companies. It was started by a Stanford graduate. And they sell, $50 to $100 million contracts on some cases. And they're selling into a the CRO as the buyer, and they're having to figure out, here's your workforce, here's how we like map our solution to your workforce, here's how we map that to a budget, and there's just a very heavy solution component. Under the hood, their tech is actually mostly a fintech platform that allows for the facilitation of payments between the employer, the educational like program provider, and then also the student. Although in many cases, the student comes out of pocket, not at all. And so the solutions component is the very, very heavy component of both the sales process, because you have to figure out how to map that all in. So it's just saying like if they have a solutions org, and if they're doing, contracts that are north of $2 or $5 million, then you're going to end up with a solutions-heavy company.
This is Utku. I worked at like Mastercard and Mesh Connect. My question is, especially when you think about US fintechs, what are the main challenges that try to like figure out? Like customer acquisition is one thing, but are there any other prominent things that people are figuring out?
Yeah. So customer acquisition and consumer has definitely been a very interesting problem for people to work on over time. And one of the challenges I have underwriting consumer at the pre-seed and seed is just because you see a certain cost of acquisition at an initial scale, you have no idea that that cost of acquisition will still be true in 2 to 3 years, because preferences can shift, the platforms you're leveraging, their traffic can shift, the channels can become more crowded. So cost of acquisition in consumer fintech is probably the number one problem that people think about and struggle with, which is why when I like to think about investing in consumer businesses, it's trying to find some sort of very interesting distribution strategy that's likely to be very durable. It's very hard to find companies like that you feel like you can identify and de-risk that at the pre-seed or the seed. So in the consumer side of things, I would say that would be it. On the B2B side of things, it really comes down to execution, like picking the right market with the right pain point and then executing against it, because some of these motions are very, very complex. I'm an investor in an embedded payroll company, for example. I think they're the best team in the market. I think they have the best solution in the market, but it's a very solutions-heavy sale, and it's a complex sale, and executing both on the product and on the sales and the solution is a big, big lift. So when I look at my portfolio company, the main thing I worry about is just like execution against the plan and making sure that I've identified the right market and the right payment.
One follow-up question. I read your article in LinkedIn about like lending can be bullish about lending. What is the main problem of the lending companies then?
So lending companies, consumer lending companies have that cost of acquisition problem. If you also don't have some sort of proprietary distribution, you can also have issues where you get your most common customers are not the best customers. For example, a lot of the consumer unsecured lenders, you actually have individuals who are borrowing from 3 or 4 of them at the same time, and those lenders don't know it. So cost of acquisition is definitely a big one. But then you also have things like macroeconomic tailwinds, headwinds, changes in consumer sentiment and behavior. So consumers like a whole different area where I don't spend very much time. Most of the business lending I do spend time with is very short duration, where you can cycle through your whole loan book in a month or 2 months. So even if you're a 2-year-old company, you can go to investors who are investing in the A or B and you'd be like, look, we have cycled through our loan book 10 times with these customers, and you'd have like, it's B to B to B. So with these, channel partners, and we've experienced 0 losses. Whereas if you're originating longer term debt, that's 5 years, 10 years, especially if it has a balloon payment at the end, and you're like, look at all this revenue we're doing. You're like, well, I don't know how good that is. So you can solve for a lot of the problems in lending by having good distribution, I think, across the stack. And 2 is the shorter duration, the easier it is to show that you're actually underwriting risk appropriately. And if you look at a firm and some of the buy now, pay laters, they've shown pretty good ability to manage that, and they have a bunch of different products that have slightly different tenures. I think they go maybe up to 24 months now at the firm for some larger purchases.
Hey, my name's Connor. I used to work in sales in Stripe. I was hoping you could tell us about how you assess fintech investments generally, what you look for.
So founder market fit is like the biggest one. I used to be pretty thesis driven and try and like pick out areas, especially when I was in Andreessen Horowitz. I've kind of stopped becoming super thesis driven because I've found there are like 3 different problems you have with these super thesis driven. One is you come with a thesis, there are no companies. Okay, so you obviously can't make an investment. 2, you come with a thesis, there's one company, it's a bad company. Do you still invest in the company? 3, you come with a thesis, it's a good idea, there are 10 companies. Now what do you do? So there's all these problems with being overly thesis oriented. I think especially at the pre-seed and seed. So what I look for is founders who have a unique insight to the market. I try and come to the meeting with a prepared mind, either from years of work or maybe just some pre-work before meeting them, and then have them teach me something that's very interesting. And typically, even if they're pre-seed, which means pre-product, pre-revenue, they will have 2 or 3 referenceable customers who said, when this is ready, I will buy it. And so that's what I really want. Smart founder, good market, teaches me something new and proves out customer demand by selling vaporware and they're selling vaporware because they have the clout with the prospective customer to do that. And the customer's like, I know who you are. I know you're going to be able to build this, and this is a big enough pain point for me that I'm willing to like commit to something that doesn't actually exist. And so you can actually make, and this is another reason why investing, I tend to do more B2B. I would love to do more direct consumer. You can de-risk a lot for a pre-product, pre-revenue company if you have the right founder, the right market, and the right kind of initiated customer demand. Also call out sales at Stripe is one of the orgs I think about in terms of thinking like why solutions and sales matter. One of my friends is James Diet. I don't know if you've worked with James Diet, but like I remember when he talked to, so he's like, I tell all my friends, and he went to Harvard, so for business school. It's like, I tell all my friends I look at like work in sales and they think I'm a Luddite and like dragging my knuckles on the ground. You're like, actually the most important thing Stripe, and you can maybe opine and give your own perspective, has had to figure out in the last 4 to 5 years is how to move from a bottoms up SaaS, well, I don't know if you call it SaaS, but a payments company selling to developers to payments volumes. There's the classic payments triangle, which is all of the volume, although not much of the margin is at the enterprise, and then all of the margin, but not much of the volume is at the SMB, and Stripe was somewhere in the middle with these like startup developers, was figuring out how do you have an enterprise sales motion, go-to-market, and product. And that, as I'm sure, I don't know what years you were there, but for a while it took a lot of time to figure out exactly what that would look like. And Checkout would be the opposite, where they started with very few large customers, white glove onboarding, and those are both very big, valuable companies. One of them started from the idea of the sales and the solution being the most important thing. The other started with the kind of bottoms up. I will say the bottoms up thing, it can work great because it tends to lead to better products over time because you're closer to the actual end user, whereas you're selling to an enterprise buyer, but the developers, the user, there's just a lot of room for things to get lost. But even if you're kind of this bottoms-up motion with a superior product in some sense, you still have to learn out a lot to figure out the enterprise sales.
I wanted to ask you specifically about like what are you seeing with tech, but in your regulatory specific trend and like accelerate growth or open opportunity?
Yeah, the why now is interesting, and in fintech, in some ways, the why now is easier because financial services is highly regulated, very slow to move. And you can follow the trends that are happening in the rest of the tech ecosystem and then kind of apply those trends to how you understand financial services work and be like, okay, this happened 10 years ago for 10 or 15 years ago for startups. It happened 5 or 10 years ago for enterprise. Now it's probably going to start happening to banks. So like the example I've given on that before is cloud, which is not like a new trend. US launched in 2005. 2021 is when JP Morgan announced the migration of one of their core banking systems to the cloud. They had migrated other workloads and data things to the cloud previously, but in terms of a core banking system, it took them 16 years from the advent of, you can argue cloud computing started before AWS too, so like 16 years to get into. So sometimes it's just looking at these trends that have been long running and being like, it is time for this to happen in financial services. And sometimes it can be literally just replacing paper and fax-based processes for certain areas. So I have one company that's automating the back offices for physicians and small medical practices, and they're digitizing checks, they're looking at explanation of benefits, syncing those up with claims, doing that all in a fully automated way. And it just seems obvious that that should be a thing. It's just taken a really long time to be able to come into here. I have another company I've invested in that's a modern transfer agent, which probably doesn't mean anything to most of you, but if you're familiar with Computer Share, they're an $8 billion incumbent in the industry. Some of you, if you've been through a liquidity event, when the company goes for an IPO, you get like an 800 number, and you've got like $2 million, $10 million sitting somewhere, and you get this 800 number. You call the 800 number to figure out where your $10 million is, and then you're like on hold for 2 hours, and for 3 months, you like literally can't figure out where your money is. The person in charge of that is called a transfer agent. They're the one in charge of moving the shares from basically the company to the new owners at the IPO. They also do a bunch of other things, proxy voting, equity compensation plans for publicly traded companies. There's been no innovation in the whole transfer agent space. So I backed a company there with a great founder who oversaw disbursements at AngelList, saw this problem firsthand, taught me more about the market a market I was like a little bit familiar with, but definitely needed a founder to be like, look, here is how I'm going to approach it. And so you can just, and it's all these paper-based, very broken processes. So the why now is just that financial services is very, very slow, and you track some of the existing trends across the ecosystem.
We'd love to hear some of the mid-stage growth companies you mentioned in the fintech space that you're watching.
Yeah, so mid-stage, I would say, again, any company that you see an announcement that has raised a new round of funding at an up round is default a very good and interesting company worth tracking, because if they've raised an up round in a down market, that's great. In terms of like specific ones, outside of that, I'm so focused on doing like the early stage stuff. I don't have ones that I'm like really tracking and thinking about precisely all the time. I can call out one, I guess, because I did end up investing a small amount personally, and that's Altruist. They're building like a modern tech stack for RIAs, and they're doing some really interesting work there. I invested in, I think it was the Series D or so last year. And I call them out because I think they're doing really interesting work in an area that's seen very little innovation. You'll see a lot of companies that sell SaaS into RIAs, and so they charge a few $1,000s, but they're like 10,000 RIAs, so you like multiply 2,000 by 10,000, you're like, oh, that's not a very big market. So if you want to build a really big company in wealth, you actually need to be able to fee against the assets, probably doing the clearing and custody, and do a bunch of the SaaS work on top of that, and Altruist does that. And once you do that, it actually creates the opportunity for what I think is a very big company. So they have a lot of work to do, but I think the potential upside of them is, $100 billion, potential size of company. And I say that about very few. So that's one at the growth stages.
My name's Adam. I worked in traditional banking as well. I used to run derivatives desks, actually structured solutions desks for big investment banks, Bank of America, Merrill Lynch, and Citi. And then I built a film financing business, so focused around payments and things on that. I am currently looking at the intersection of AI, ML, and insurance. So looking at different ways it can parse data and evaluate claims values, et cetera. And I'm just curious to know, in your view, what percentage of companies generally make it from pre-seed to a significant exit?
This is off the top of my head, so the exact numbers might be a little bit different. If you look at a unicorn efficiency ratio for your seed fund, I think the market median is around 3%. And then if you want to be a top performing seed fund, it's like 6 to 9%. So if you do 30 investments, and again, markets change. There are a lot of unicorns being born a few years ago. Market data that looked at the last 10 years is not necessarily what the next 10 years is going to look like, but it's kind of 1 out of 30. And then if you're very good at your job, it's kind of like 3 out of 30. And so what I underwrite to in terms of me as an investor is I have about 30 companies in the portfolio. I would like one of them to be worth north of $5 billion, and then one other one to be, a substantially sized unicorn. And I would love for more of them to do well, but it's just math and history tells us that it tends to be something like that is what drives the vast majority of returns for pre-seed and seed focused funds. I do think one thing that's very interesting, I'll be interested to see out, is just I back a bunch of really great founders building really interesting things, and the value of the platforms they're building have a lot of strategic value that should be very interesting to a potential strategic buyer. And so I also expect there'll be a lot of very kind of meaningful, interesting acquisitions. Beyond that, they just might not be, $1 or $5 billion companies.
Going back to the payments industry a little bit, do you think, because right now we're talking a lot about the commoditization of the industry, how can we differentiate? Is there any space for AI to play a role in that, do you think, in terms of trends? And eventually, in payments specifically? And eventually going out from the SaaS. I know this becoming a verticalized software in payments, it's where everybody's going, but then is there something else that you saw that's different from creating differentiation and going move around the problem of just price competitiveness?
Yeah, there's probably a bunch of different ways to answer that. So one, for AI on top of existing payment rails, I don't think that could increase authorization rates or provide data analytics insights. I think that's gonna be really, really hard for startups, because the big players who have a lot of data and a lot of volumes, they're probably gonna build that stuff, especially if it's on top of existing data rails. One of the things I'm excited about is there are a bunch of different and new payment rails. And then you actually it's not really necessarily even about the AI, but USDC is in some ways much more programmable. Well, in many ways, much more programmable than say ACH, right? It's something that's designed to be interacted with in code. And so USDC as both a store of value and a payment mechanism is kind of interesting. Or just RTP from both FedNow and then also RTP from the clearinghouse. So those new payment rails will provide a lot of value. But I think you're right, and you started to talk about this, that the biggest opportunities for AI and payments won't really be AI and payments. It will be vertical software where you use AI in some way to automate some core set of workflows for a business. you build holistic business software that just makes it, it's business in the box for, you've got the toast, the hair salons, but there are thousands of different ones. You get the business in the box and you happen to do payments. So that AI automate, and in financial services, there are a lot of paper-based workflows, and using AI to parse and deal with that unstructured data, I think we are at a point where you can do that, at least do it more quickly and more cheaply than you would have been able with less training data than you would have historically. And so AI is going to be a big boon for vertical SaaS, because vertical SaaS depends on automating workflows. And then one of the big ways vertical SaaS monetizes is through payments. So vertical SaaS and AI come together, and then payments kind of sticks into that. But in terms of like AI on top of like Visa, MasterCard rails, for like a net new company, it's probably going to be very hard to impossible.
Hey, I'm Matt. I worked at PayPal. We talked a little bit about what investors, or what you as an investor look for in founders, but what do you think a fintech founder should look for in an investor?
Yeah, I think they're realistically, there are a couple different things, and it depends on the business you're building. The easiest one to talk about is brand, right? If you raise money from a Sequoia A16Z benchmark, it's like a great brand, and you can tell employees, like, they invested in us, we're a good company, right? You can tell prospective customers, we have these great backers, like, you should believe that we're gonna build a really great product. So brand is a really, really big one. And I think a big shout out to Andreessen Horowitz, one of the things they really invested in as a firm was building a brand, both through the media presence they built, but also through a lot of other things they did, like building out the professional services organizations. So they have like a whole bunch of experts for human resources, for sales, for go-to-market. They have a whole talent team that supports their portfolio company. So brand is like the easiest one, and it's the one that you all kind of already understand because you like see a headline that like XYZ big firm leads around, you're like, oh, that must be interesting. Two is network and connectivity, and that will often mean helping you find initial customers. I think especially in fintech, founders are really lucky that there are firms that may not have the biggest brand, certainly not like an A16Z or a Sequoia, but actually who will be more helpful than those brands would have been because of the industry connectivity they have. So I mentioned I have like 2 or 3 companies that are building bank tech. They're building software they sell into banks. When I look at a bank tech deal, there are usually 2 or 3 different funds I will ping. 2 of those funds have 70 plus banks as LPs who would all be prospective buyers of that technology solution. Getting one of those firms to invest and then get you in front of their 70 prospective customers when you probably need 3 to 4 to 5 of them to hit $1 million in ARR, which de-risks your Series A, that is going to matter way, way more than like having some shiny brand. It's going to be customers and traction. And that's not just true for folks in bank tech. If you're building an insurtech, there are some funds that all of their LPs are insurers. And so I've worked on a few different insurtech deals, and I'm usually a non-lead or a co-lead. And so I'll bring in other folks to invest as well. And I'll try and get one of those insurtech focused funds, whom you guys probably have never heard of in some cases, and get them to invest because like, look, I know you're gonna get them in front of the 5 carriers, the 10 brokers, the whatever else, that will help you get customers and traction, and that matters more than brand. So network in fintech especially is something you can really solve for with your investors. And my goal, like I've helped companies find employees, infrastructure partners, channel partners, first customers. If they're selling into like other fintech companies in some way, I have one company that's a reg tech company, another that's doing embedded lending. Like I can sell 30% of their pipeline for the first year. If you're not selling into fintech, like I probably send you like 1 or 2 customers. Sometimes it depends on the exact shape of it. But brand is the big one, and network connectivity is the second, I think. And fintech network connectivity is something you can really get a lot of bang for your buck with the right people. I'm kind of curious, like what do like people at GSB want to do in fintech right now? Like what is everyone talking about? Like, oh, I want to go like work in product at a payments company, or like do you feel like there's something in the water, like this is the thing in fintech that people are excited about right now? Or you're like, I don't know, it's kind of a messy ecosystem and fintech is like a little bit uncertain. What's your just like general sentiment?
I feel like those that are building on the consumer side, but trying to simplify difficult areas, so like taxes as the hook, and then finding different ways to add other services.
Yeah.
We got 2 builders at the back.
We're building a tax,
Yeah, I mean, it's interesting, like a year ago or 2 years ago, this room would have been like packed. But now, like, I think fintech has consolidated to people that are very much into the subject matter. But yeah, I don't know. Finding the right, I think with AI as well, it's like so much potential, like, to build a toast for a particular vertical, but which vertical do you build in, and can that be a big business?
Yeah. For those of you who are exploring vertical SaaS, I'll just call out, there have been a lot of vertical SaaS companies started. Has anyone heard of Fractal? by any chance? They're a studio that does this studio, which is Nate Baker, who's one of the founders and CEO of Qualia and some other folks, started this studio. They have over 100 vertical SaaS companies they've started in the last 2 years. So it's just kind of crazy to think. And that's just one studio. And there are a bunch of other folks who have started vertical SaaS companies as well. So
Cool. Well, can we get a round of applause?
So that's it. Those are some of the questions I got after my talk at the Stanford GSB. If you want to see the talk that precipitated those questions, make sure to check out the link in the show notes and/or hit subscribe. In that talk, I covered very specifically and tactically, 1, what kind of company to work for, 2, what kinds of roles are very interesting in the ecosystem and fintech ecosystem today, and 3, if you want to break into venture, what that can look like. Be sure to check out that full talk. Again, link in the show notes if you want to get into that.